Hi, this is Jon Guest again, and we're going to go through the answer to question 3 from the article in the November 2015 edition of the Economic Review. So the article talks about what would happen if the rate of interest were regulated, what impact would this have on the market, and try to use the concept of deadweight welfare loss in your answer. Now, the rationale behind setting this question is the fact that the government has implemented a cap of 0.8% per day interest rate, or cap on the interest rate of 0.8% per day that can be charged on payday loans. So now it is illegal for a payday loan company to charge a rate of interest above 0.8% per day. And this is a clear example of a maximum price. And actually, the whole issue of maximum prices is discussed in more detail in an article in the October edition of the e-Review. And that actually talks about the legislation that the government introduced into the payday loan market in more detail. So you might find it useful to read that article following looking at the answer to this question. So let's imagine that the government, so the free market rate would be RB. Well, assuming we're focused on the payday loan market, perhaps that's 1.2, 1.5% per day, and this is seen as unacceptable. So the government regulates and it sets a rate of RC. So now interest rates are not allowed to be set above this level. Now, what's this going to do? Well, obviously it's going to have an impact on both the supply of loanable funds. This lower interest rate is going to act as a disincentive for people to save their money. So we're going to have a reduction in the quantity of loanable funds supplied. So it'll fall from the equilibrium of QC to QA. At the same time, at this low interest rate, the quantity demanded of loanable funds will increase. So if we look at point W, and this would mean that the demand for loanable funds can be represented by the point QE. We can see clearly in the diagram that the demand for loanable funds at point W is greater than at point Y, and if the market was unregulated and it was competitive, the interest rate would simply rise to point X, and we'd be back to our market clearing level. But the government's regulated this. They've said that will not happen. It's illegal. Now, the second part of the question talks about the concept of deadweight welfare loss, and you may in your studies have come across the concept of consumer and producer surplus. Now, because this is the market for loanable funds, actually we can think of this in terms of lender's surplus and borrower's surplus. So we can see here that the borrower's surplus would be this area here. Okay, so we've got this area under the demand for loanable firms. So if we travel down this demand curve to point Z, then down to point Y and across to RC. Okay, now without intervention, this borrower surplus would be this triangle. So we'd start from the intercept here, we'd move down to point X and over to RB. The lender's surplus would now be, after the imposition of the maximum price, would be area RC, Y, and down to the origin here. Obviously, without the regulation, the surplus would be RB, X, and then down the supply curve to the origin, so this area here. So we can see that the surplus to the lenders has fallen quite considerably. But if we look at the total surplus to the borrower, okay, the difference between the interest rate and the demand for loanable funds, and the surplus to the lender, the difference between the supply for loanable funds and the interest rate. If we add those two together, we can see that the total areas got smaller. So with the free market, we would have this whole area here. So we'd move down the demand curve to point X, and then down the supply curve to the origin. So we'd have this whole area here, which would represent the total surplus. Following the imposition of the maximum price, the area would fall to this area here. So from the intercept on the y-axis down to point Z, down to Y, and down to the origin here. So the total surplus has fallen by the area ZXY. So this area here. So total surplus was originally this whole area. Now it's fallen to this area, which I'm outlining with the arrow. So the total surplus has fallen by ZXY. So that's the fall in the total of lenders plus borrowers surplus. And this is what deadweight welfare loss, the reduction in total surplus. This is what it is. So the deadweight welfare loss of the imposition of this interest rate cap would be ZXY. And effectively what the cap does is it stops potentially mutually beneficial trade. So there are people here who are willing to lend money for a higher interest rate. There are people willing to borrow money at that interest rate and at higher rates than the interest rate that people are willing to lend for. And this is blocked by the government legislation. So in effect, mutually beneficial trade is being blocked. And if you look at the textbooks, one of the potential implications of a maximum price is we may get a black market and a legal market where the people who want to lend the money at these higher rates and the people who want to borrow money at these higher rates might meet, and the money might be lent illegally. One of the great concerns when this legislation was introduced in the payday loan market is that there would be an increase in illegal lending going on. And again, that's something that's discussed in that October edition of the e-review in more detail. So hopefully you found that interesting and useful, and again it gives you hopefully a good answer to the third question. So thanks for listening, and obviously there'll be more model answers online to go with future editions.